fear of losing money isn't just logical, it's deeply psychological. Today, we're diving into 10 surprising, science-backed psychological facts that explain why you're afraid to take financial risks and exactly how to break free. Stick around for the second half where we show you how to rewire your brain for confident money decisions. Let's go! 1. Uncertainty intolerance increases cortisol levels. Studies from the University of Wisconsin show that people who score high in intolerance of uncertainty exhibit 30 to 40% higher cortisol levels under financial ambiguity. This makes risk feel physically unsafe. It's not the numbers, it's your nervous system in survival mode. What it means for financial risk. Cortisol is released when your brain thinks you're in danger, like being chased by a predator. If your brain sees financial ambiguity, e.g., unpredictable markets, unclear outcomes, as a threat, your body reacts as if you're in physical danger. Even if the numbers say the investment is sound, your nervous system screams, unsafe. This fight or flight response can lead you to avoid risk altogether, even when it's rational. So, it's not that the investment is risky, your body is interpreting uncertainty as danger, making it hard to think logically or act boldly. 2. Future self-disconnect reduces investment willingness by 33%. Research from Stanford shows that people who feel disconnected from their future selves are 33% less likely to make long-term financial decisions like investing. The brain treats the future self like a stranger, which reduces protective behavior like saving or investing. What it means for financial risk. Your brain may treat your future self like a stranger, so taking financial risks today, like saving or investing, feels like you're sacrificing for someone else. This reduces the motivation to invest, because the reward is delayed and goes to a version of you that doesn't feel real or relatable. So, when you don't emotionally connect with your future self, it's harder to justify taking present-day risks that only pay off later. 3. Rejection sensitivity amplifies fear of entrepreneurial failure. A study in Journal of Anxiety Disorders found that individuals with high rejection sensitivity report 50% greater fear of business failure, especially in startups. Emotional risk, judgment, failure, feels as threatening as financial loss. What it means for financial risk. Starting a business involves both financial risk and emotional risk, like judgment, criticism, or failure. If you're rejection sensitive, the emotional pain of failure can feel just as bad, or worse, than losing money. So, even if a business idea has strong potential, you may avoid it to protect yourself from emotional exposure, not just financial loss. So, the fear isn't just losing money, it's the social and emotional fallout. That fear can sabotage smart entrepreneurial decisions.
4. Financial trauma shrinks risk tolerance. According to a 2021 report by the National Endowment for Financial Education, people who've experienced financial trauma, e.g., bankruptcy, foreclosure, develop a 42% reduction in risk tolerance, even when logic says conditions have improved. What it means for financial risk. Financial trauma rewires your brain and nervous system to expect danger. Even if the market looks safe or you've recovered financially, your body remembers the pain of the past and says, never again. This can lead to overcaution and missed opportunities because the fear response doesn't always listen to facts or logic. So, past financial pain can make even safe risks feel unsafe, limiting your ability to grow wealth or try again. 5. Overgeneralization bias triggers risk aversion after one loss. A study published in Nature Neuroscience showed that after a single financial loss, the brain's amygdala overactivates and generalizes fear to similar future events, even if they're unrelated. One bad experience can shut the door on dozens of good opportunities. What it means for financial risk. Imagine you lose money in a real estate deal. Your brain may start flagging all real estate, or even all investing, as dangerous. Even unrelated opportunities that are objectively safe can now trigger fear. That one bad experience can shut you off from many good ones. So, one failure can make your brain overprotective, leading you to avoid whole categories of risk, even when they're not connected. Part 2. 5 psychological shifts that help you overcome financial fear. 6. Mental simulation training reduces fear by 27%. Researchers at the University of Colorado found that visualizing success in financial decisions called mental simulation, reduces anticipatory fear by 27%. The brain responds to simulated experience almost as powerfully as real experience, prepping you for courage. What it means for financial risk. Before you take a financial risk, fear of what might go wrong often holds you back. But when you imagine things going well, like making a good investment or navigating market dips successfully, your brain starts to treat it like a real experience. This creates mental muscle memory, reducing fear and making it easier to act. So, your brain can't fully tell the difference between imagined and real experiences. So visualizing success actually makes you braver with financial risks. 7. Exposure therapy rewires risk tolerance. Gradual exposure to financial decisions, like microinvesting, helps desensitize the brain's fear response. A 2019 study from the University of Amsterdam showed that graded financial exposure increased risk tolerance over time by 39%, without increasing anxiety. What it means for financial risk. Just like people overcome phobias by slowly facing fears, e.g., holding a spider, you can train your brain to get more comfortable with financial risk. Starting with small, low-stakes investments builds tolerance, helping your nervous system calm down and adjust over time, without increasing anxiety. So small, consistent exposure to financial risk is like going to the gym for your risk tolerance. Your brain becomes less reactive and more confident.
8. Identity framing increases action by 45%. When people reframe decisions based on who they are instead of what they want, financial behavior changes. A study in behavioral science and policy showed that when people see themselves as investors instead of savers, they are 45% more likely to take calculated risks. What it means for financial risk. The way you define yourself changes how you behave. If you think of yourself as someone who actively grows wealth, you're more likely to engage in risk-informed behavior like investing. But if you see yourself only as someone who protects money, you'll default to safer actions, even when growth makes more sense. Who you believe you are shapes what you do. Identity-based thinking activates behaviors aligned with growth and risk-taking. 9. Financial self-efficacy predicts success more than income. A 2020 study published in the Journal of Economic Psychology found that belief in one's ability to handle financial matters, self-efficacy, predicted smart risk-taking better than income level or education. Confidence, not cash, leads to better financial decisions. What it means for financial risk. It's not about how much you make, it's about how capable you believe you are. If you trust yourself to understand financial concepts, recover from mistakes, and make decisions, you're more likely to take smart, intentional risks. Without that confidence, even wealthy or well-educated people can stay frozen by fear. So financial risk-taking isn't just only about knowledge, it's about self-trust. Confidence drives action more than cash or credentials. 10. Cognitive reappraisal deactivates the fear circuit. A Harvard study showed that using cognitive reappraisal, reframing a risky financial situation as a challenge rather than a threat, deactivates the amygdala and increases action-taking by 32%. Your interpretation shapes your reaction. What it means for financial risk. How you interpret a financial decision matters. Seeing it as an opportunity for growth rather than a danger to avoid literally changes your brain's chemistry. This technique, called cognitive reappraisal, lets you respond with curiosity and courage instead of fear and avoidance. So it's not the risk itself, it's your story about the risk. Shifting your perspective changes your reaction and unlocks better decision-making. Fear of financial risk isn't just a mindset, it's a complex web of emotional, neurological, and psychological wiring. But the good news? It can be rewired. Pick one of these shifts and try it today. Let me know in the comments, what's one financial risk you've been avoiding? And don't forget to subscribe for more science-backed strategies to level up your money mindset.